Good morning, and welcome once again to Digital Look TV from London. Joining us today is Bill Hubbard. He is Chief Economist at Markets.com. Bill, thank you very much for joining us.
Thank you very much for inviting me.
Okay, last night, one headline flashed across the screens of every trader in the world from Bloomberg News. Officials say that forecasts overstate pace of rate rises. Immediate reaction from the markets, very dovish. Do you buy this?
I presume you're talking about the FOMC minutes.
Indeed, yes.
Okay. My feeling was the minutes were even more dovish than I expected. And if you read through the minutes, and it was quite interesting because there were a number of governors who weren't there, and it was a conference call. Mm-hmm. And if you listen to each one of the comments, there was only one person, okay, and it was Chairman Yellen, who put a specific date when she said at her first press conference that interest rates will probably rise within 6 months after quantitative easing ends. Well, as we saw then, we saw a sort of move back in the Treasury 10-year to 2 3/4. We saw a mini rally in the dollar. Last night, there was no mention in reference to a time frame. The market then says we're going to have interest rates lower for longer. We saw both the Dow, the S&P up more than 1.1%. The negative bondholders, and I won't mention PIMCO and some of the problems they're having there, talking about 3%. Well, last night, the Treasury 10-year ended at 2.65, and as we've looked at this morning, the dollar is getting hammered, and I mean hammered big time, all indicative that rates in the U.S. will be lower for longer. Forget the 6-month scenario. This was her comment only, and nothing was mentioned in the FOMC minutes about any time frame for interest rates.
Fantastic. So the dollar got hammered.
Yes.
The euro snapped back up quite quickly.
Yes.
What's going on there? Is the euro finally going to see some weakness? It just doesn't seem to.
I'm probably not the person to talk to because I got it big time wrong in 2012, big time wrong in 2013, and up until probably maybe 6 weeks ago, I was in the 130-ish camp. But I mean, one thing that we did see, and I don't want to get too technical, but last Friday after non-farm payrolls, we did see the euro touch 136.80. Now, again, I'm not a technician, but in reference to how the option volatility is, okay, the option volatility is the lowest it's been in 2 years in the euro and 5 years on sterling. And if you looked at that, you know, you've got the 50, 100, and 200-day moving averages. Well, the 50-day went below, which it shouldn't. So therefore, you know, as I wrote last week, looking at that, no chance near term at all of seeing the euro go down to 136 or dollar yen are at 102.50. And as you said right now, I mean, what are we, 138.50, something like that? And even sterling, again, soaring right here. So we are seeing, the simple fact is that, you know, so many people basing the dollar move on interest rates going up. Everybody talking about, well, we get to 3%, okay? Right now, we're not getting anywhere close. So now it's going to be a question of how concerned will the ECB, will the Bank of Japan, and the meeting today with the Bank of England do, feeling that the dollar is going to get no strength from any interest rate talk from the Federal Reserve.
Okay. However, the consumer price inflation in the Eurozone is quite low, perhaps even atrociously low.
How low is low? Yes, yes.
So then on that basis, for example, in Spain, you have core inflation, which it is about to turn negative in year-on-year terms. The ECB does not act for whatever reason. You were telling me before that perhaps what would be ideal is if in the Eurozone there were a system akin to what we see in the United States, where in different geographies within the Eurozone, central banks had a little bit of autonomy with a sort of discount rate.
Well, see, this is why I've never been a fan from the European Central Bank. You know, it's okay when the economy's moving, when there's a one-size-fits-all. But as you just said, I mean, right now, you have 4 countries in the Eurozone, one of which is Spain, as you said, who have negative inflation, okay? Now, at 135, 136, and now at 138 plus, they're going to get murdered. I mean, we had a conference in Bratislava just 10 days ago, okay? The young people saying, with the euro at this level, we have no opportunity for jobs. We have no opportunity for exports. Our industry is just non-existent, okay? Now, you know, I was I think I felt that the ECB was correct in October when they dropped rates. I was expecting, I guess, like everybody else, a move last month. I don't see any change, but I think as long as with each tick up, they've got to do something, if not before, probably at least June. But now it's going to be quantitative easing, et cetera, et cetera, et cetera. And I mean, I even made this comment, you mentioned Bloomberg. I even made this comment a couple of weeks ago on Bloomberg, quantitative easing. Maybe they buy U.S. Treasuries.
Maybe. Okay. That would be certainly a drastic
Well,
step.
they've got a lot of dollars to use.
They certainly do. Okay. Lack of opportunity in Bratislava. There's also a bit of a lack of opportunity here in the United Kingdom, London. Young people. Wages are quite low. Employment for young people, not precarious, but not ideal conditions. They want to buy a house. Many of them cannot.
You want to do what?
Buy a house.
What?
Exactly right. Exactly your point. London house prices up 18% year on year, last number. A bit worrisome. So again, as in the Eurozone, but for much or pretty much exactly the opposite reason, should perhaps the Bank of England at some point consider also implementing something akin to the discount rate system in the U.S.?
I don't know. This is difficult because you see, when the Fed was set up, and we're talking February of 1913, what they did was they set up the Federal Reserve districts. And as you just mentioned, we have the generic repo rate, okay? But each Federal Reserve district has what they call the discount rate, okay? So they can, in the old days when interest rates went up and down, or they were 6, 7, 8%, not 0 to a quarter, each district has the chance to adjust the rate. Now, look, Detroit's in the Cleveland district, all right? Well, if anything, I know that they have a negative interest rate, okay? Because they'll give money away to try to go to. Now, in Silicon Valley, which is booming, okay, San Francisco Fed, okay, their discount rate is always, and for the last well over 2 years, has been higher than the repo rate. This is something, again, I'm not going to get involved with the politics on how you break down, the Wiltshire district or the Hampshire district or this, that, or the other. This is something that again, one size does not fit all.
Okay. And then back on the currency front, much like the Eurozone, sterling is also quite strong.
Yes.
What might that be telling us?
Well, I think sterling has been telling us something that Mark Carney has not been telling us. Sterling has been telling us, I think, for the past, at least so far this year, that we do not believe you that interest rates will not go up until the end of the first or the beginning of the second quarter of next year. I'm still and maybe I'm the last person in the country that feels rates won't go up until February of next year. Nothing will happen today. But the market is basically telling us now, and as you just said about the housing, we're talking probably as early as December this year that rates will have to go up to try to cool off the economy. But then it goes back to the 11.2 million people. As you said, wage inflation is only 1.47%. And even then it started to go up. 3 months ago, the spread between inflation and wage inflation was the widest in 50 years. So your credit card bill's going up, your food bill's going up, your energy bill's going up. And hey, come December, will your mortgage bill start to go up?
Quite a whammy.
Okay? So that could cool. And as we saw yesterday with the import-export data, I mean, this is the worst it's ever been. So we're not selling anything abroad. And if the consumer doesn't, quote, bail us out, and everybody says to get a legitimate recovery, I don't care where you are in the world, the consumer has to start spending. Well, with inflation non-existent, the consumer is not spending.
Okay. So rates might rise in the UK as early as December. In fact, they probably will. Bill Hubbard, Chief Economist at Markets.com. Thank you so much.
Thank you very much.